Oracle Corporation reported fiscal Q4 2026 earnings after the close today. Record revenue of $19.2 billion beat the $19.1 billion consensus. Non-GAAP EPS of $2.11 beat the $1.96 estimate. Cloud revenue hit $9.9 billion, up 47% year-over-year. Infrastructure as a service revenue reached $5.8 billion, up 93%. Remaining performance obligations grew to $638 billion, up from $553 billion last quarter. So why did the stock drop? The regular session closed at $200.72, down 2.65% on the day. But the after-hours reaction was worse. Oracle stock fell roughly 7% from that close. The reason? Capital expenditures. Oracle spent $55.7 billion on Capex this fiscal year to build out AI data centers. The company announced plans to finance approximately $50 billion in new debt and equity to continue the build-out. The market interpreted this as dilution and margin pressure. This was a classic great quarter, terrible guidance reaction. The implied move heading into earnings was 12.7% on the weekly options. The after-hours move came in around 7% to the downside, within expectations but on the wrong side. Oracle is now trading at levels not seen since early May. The question going forward is whether the Capex cycle peaks in fiscal 2027 or continues to accelerate. For now, the market is voting no. That was Oracle, the earnings everyone was watching. But the structural story this week was not Oracle. It was the first full week without the pattern day trader rule. 1 week ago, we released 3 videos on Market Lens covering exactly what would happen when the PDT rule died. We ranked brokers, we predicted market structure shifts, we identified which platforms would win and which would bleed. This is the post-mortem. Here is what actually happened. Let me recap the call we made in the democratization gap video. We predicted the PDT elimination would flood zero DTE markets with new retail capital. We said brokers would need to compete on execution quality, not just user experience. We warned that liquidity would fragment and that the 18-month FINRA phase-in would create a 2-tier market. Brokers ready on day 1 versus those playing catch-up. 1 week in, here's what the data shows. Broker stocks had a mixed week. Robinhood closed June 3rd at $82.85. On June 4th, Pacific Daylight Time Day, the stock jumped 6.6% to $88.33, a clear event pop as traders priced in the new addressable market. But by June 5th, Robinhood gave back those gains, falling 6.6% to $82.47 as the broader market sold off. The stock recovered to $87.16 by today's close. Net result? Up roughly 5% since the rule change. That is constructive. The market is pricing in Robinhood's structural advantage, massive user base, crypto integration, and the new World Cup event contracts they launched on June 4th. Even if the immediate trading volume data is still incoming. Interactive Brokers closed June 3rd at $87.15. On Pacific Daylight Time Day, it barely moved, down 0.1% to $87.06. By June 5th, it had sold off to $84.40. It recovered to $86.33 by yesterday's close. Net result? Roughly flat, down about 1%. IBKR is the institutional play on this theme. The market is not pricing in a retail boom for IBKR because IBKR was never a retail-first platform. Their volume will grow from existing professional traders scaling up, not from new accounts. Webull Corporation, ticker BULL, was the biggest loser. The stock is trading near 52-week lows around $5. It is down roughly 7% since June 3rd and 38% year-to-date. Webull reported Q1 earnings on May 21st. Revenue grew 36% to $160 million, but the company missed estimates and continues to post net losses. The $100 million share repurchase announced May 22nd did not stem the bleeding. In the Options Broker Showdown video, we rated Webull 4th out of 5 for options trading. We flagged their aggressive automated liquidation system as dangerous for zero DTE sellers. The stock's performance since PDT confirms the market shares that assessment. Now let us talk about zero DTE volume. The data we had before June 4th showed zero DTE contracts already accounting for 40 to 50% of all SPX options volume. SIBO data from May 2025 showed zero DTE hitting 61% of SPX volume on retail resurgence. By early 2026, the average daily volume had reached approximately 4.8 million SPX zero DTE contracts, up from 300,000 in 2022. The question was, would PDT elimination materially increase these numbers? Early reports suggest yes. An article on ainvest.com from June 6th, just 2 days after the rule change, carried the headline, "Zero DTE Volatility Surges as PDT Rule Removal Exposes Traders to Expiration Risk." The Option Alpha blog noted that the new $2,000 minimum opens zero DTE trading to a significantly larger pool of retail participants. The Substack post-close analysis for June 5th specifically noted unusual activity at lower SPX strikes, consistent with new retail entrants trading smaller notional sizes. The early verdict: the volume supercycle thesis is intact, but it is too early for a definitive number. Cboe's weekly volume reports will give us the first hard data. Now let me grade our own predictions. I want to be honest about what we got right, what was premature, and what needs more time. Correct. Webull was identified as the highest risk broker for zero DTE. The combination of automated liquidation, limited analytical tools, and a stock that has lost nearly 40% of its value year to date validates every concern we raised. The CRAP framework, crypto risk, regulatory risk, alignment risk, platform risk, is playing out exactly as described. Correct. Robinhood was identified as the most day-one ready broker for stock trading. They confirmed PDT readiness early, removed PDT flags from accounts immediately, and launched new products on June 4th. The stock's recovery to $87 supports the thesis that Robinhood is the primary retail beneficiary. Too early to call. The zero DTE volume surge prediction. The mechanics are sound. Lower barrier to entry, more traders, more contracts. But we need Cboe's official June volume data. The week was also disrupted by a macro sell-off on June 5th that suppressed trading activity. Give it 30 days for a clean read. Too early to call. The execution quality differentiation. We predicted that broker routing quality would become the deciding factor as small traders scale up. This is structurally correct, but it takes months, not days, for traders to feel the difference between midpoint and edge execution on zero DTE spreads. Needs revision. The timeline for broker impact. The democratization gap video implied a sharp, immediate increase in retail day trading volume. What we saw instead was a spike on June 4th, a sell-off on June 5th on macro weakness, and then a gradual recovery. The transition will be measured in quarters, not days. The 18-month FINRA phase-in means many brokers will not even fully implement the changes until late 2027. Here is the bottom line. Oracle earnings told us the market is still punishing heavy Capex stories, even when the revenue growth is real. The PDT experiment told us the structural shift is real, but gradual. Robinhood is the early winner, Webull is the early loser. IBKR is the silent professional play. And zero DTE volume is going higher. We just need the data to prove it. If you found this breakdown valuable, like the video and subscribe to Market Lens. The next video will cover the Cboe June volume report the moment it drops. I am Daniel Reed. Stay structured.